I try really hard to not be depressing. As an economist, that's kind of difficult to do, but right now it's really, really hard to not be depressing. So if you want to pull out your phones, or there's not utensils, unfortunately, so you can't make a whole lot of noise, but if you want to like just zone out after a few minutes when I'm really depressing you, I am not going to be offended. You have your lunches, that's the most important thing. So, but I really do love having this opportunity to talk a little bit, because there really is such a mixed bag on the macroeconomic front, both nationally and in the States. As we all know, things are looking kind of interesting in the state. So I just wanted to show you guys the Economist's best forecasting tool. Right now, things are so hazy that this is seriously what a lot of people might think that we're doing, like when we're actually making forecasts. Just pull out the magic 8-ball and see what it has to say. It is a time of great uncertainty. We have presidential elections, we have oil tanking or falling or whatever you want to call it. We have coal under significant pressure here in Wyoming. On a national level, there's kind of a mixed bag. On an international level, as usual, there's kind of a mixed bag. So we'll walk through some of that today and maybe try to zone in on a little bit of clarity on the stuff that you can control. So, which is not this stuff, unfortunately. But if you look at some of the things that kind of gave people a lot of concern and a lot of fits for several years, things like the housing bust, the unemployment rate going up and up and up and up. It has, at the national level, these things are starting to really, really look a lot better. There are still some pieces of hangover from this that we have to be concerned about and think about and pay attention to, but the headline number that everybody worried about for so long has, come down over the past several years, and last month's unemployment number, 4.9% on a national level. Pretty darn good, especially considering that, a couple years ago when I was here, it was way up there in the close to 10% range. So it really has, we have seen a significant recovery in the national labor market, and that's a really positive thing. That's the last positive thing I'm going to say. Okay, no, that's not true. That's not true, but this is really good. And if you look at the underlying numbers like wages and job turnover, where people are looking for new jobs and finding new opportunities, all of those things actually look pretty good right now. There are just a couple of things where we still are a little, there's a little bit of concern. I've talked about this for a long time, so if you've heard me say it before, I'm saying it again. The labor force participation numbers in the economy have been on a significant drawdown for the last several years. And that was two things at once. That was the recession, and that was a big, bloody mess, right? That was a giant gash in the economy. So the recession really, really knocked a lot of people for a loop when it came to the job market. And a lot of people just dropped out and stopped looking. But we've also got, at the same time, of course, the baby boom generation has been retiring at increasing rates. So the labor force participation rate went way up in the 1970s when the baby boomers were entering the workforce, and not just the men, but the women were entering the workforce. So you saw a huge increase in the participation rate. And it's remained up here in the sort of 66 to 67% rate for a long time until around here, which is when the recession hit, right? Here's the recession, and it starts kind of taking a tank. You're going to see a bit of recovery in that in the near future, because the millennials who couldn't find jobs when they first got out of their college experience, they're starting to kind of peek their heads back up and go, hey, can I find a job now? Yes, yes you can, my kids. All right, go out there and find a job and bring that number back up, please. The baby boomers, they are a significant part of why this dip downs happen. The millennial generation is as big, numbers-wise, as the baby boom. So when they start sticking their heads back in, they're going to start replacing the baby boomers that are retiring. But they're doing it at such a slow rate that it's taking a bit of time for them to get up. Just as another kind of piece of data on this, if you look at the the participation rate here, focusing on prime working age, you see that it always tends to fall during recessions, but this sort of significant sustained period of downward trend, that's what we're talking about. So as soon as those millennials start coming in, start feeling a little bit less worried, cautious, and start looking for jobs and entering the workforce, that number we hope will start to tick back up to what we might consider a normal level. But the unemployment rate, if you look at all of the different forms of unemployment, not just those who are looking for work but haven't found it, but also those who are just discouraged or they're only employed for part-time for economic reasons. In other words, they can't find full-time employment. That number has been pretty high for a long time as well. Just in November of 2015, so 3 months ago, that number finally went below 10%. It went from 10 point something or other in October of 2015 to 9.9% for the past 3 months. So we're finally, again, this is the millennials starting to peek their heads out of their shells and go, all right, maybe I'm going to find a job now. Now, the thing to note, though, long term about the millennial generation, and I've said this to this group before, so you may be like, hey, this is deja vu, but when you go through a significant economic event like we just went through that we've been recovering from since 2008, it has a long-term effect on people's behavior. Millennials are going to be like the Great Depression generation, those who were kids during and or fought in World War II. They are very cautious. They're not as aggressive with their investments. They don't work for themselves as much as the baby boomers did and even Gen X did. They don't have the same kind of outlook on life. They're very cautious. That we saw in the Great Depression generation, we're seeing it now. Good piece of evidence came out a couple days ago. If you look at millennials right now in the 25 to 30 year age period, they are, if you ask them, what do you do for a living? About 2% of them say, I work for myself. I'm an entrepreneur or I'm self-employed. If you look at Gen X, at that exact same age, 6% of them said that they were self-employed or an entrepreneur. Baby boomers, 8% at that age. So what that says is that there's less risk-taking, and we're starting to see it manifested here. So, yeah, okay, that was really the only happy slide I had, wasn't it? Sorry. No, there may be more. Yes, this is happy. All right. There has been significant market turmoil. You've probably noticed that. Please, I will say it at the end of the talk as well, don't open your quarterly financial statements unless you are about to retire, okay? There's no reason, don't look. I don't care if it's high, if it's low, just don't look. You are in it for the long term, most of you, right? So just don't look. But these kinds of things, there's been a lot of market turmoil, and despite that, jobs numbers have still been growing. So ADP, which is the private firm that kind of does some private job estimations, their report this month showed January out at 205,000 private sector jobs. That was well above what everybody thought would be the report number. 267,000 in the month before. And so those are robust. Those are good numbers. And the Bureau of Labor Statistics, the government report on employment and unemployment, the two reports that they put out last Friday, those also show significantly good things. At least for January. So 151,000 jobs, which is about what everybody was expecting, maybe a little bit lower. There were two adjustments as well, one down, one up. So for November, they adjusted the number of jobs created up to 280,000 from the original estimate of 252,000, and down a little bit here in December. So for a net downward shift of 2,000 jobs net. But if you look at the jobs report from January, this is despite all the freak out that happened for significant periods of time on Wall Street there for, I lost track of how many days and weeks that was going on, and probably still is. I try not to watch CNBC too much. Private employment, more good news. Wow, way more good news than I thought I was giving you here. No, I did put these slides together. I know it's here. $13 million, or 13 million jobs up from the recession low. So 13 million jobs have come back since the recession low. It took about 2,300 days for that to happen, but it finally happened. And if you look at, there's this thing out there that the blog called Calculated Risk puts out. It's called the Scariest Jobs Chart Ever, and it shows all the worst recessions that ever happened, including the most recent one. And the good news on that one is that for the past several months, this number has been positive on a good trajectory, so that's good. If you look at where, on a national level, jobs have been created over the past month in the private sector, it's construction. It's really big down here, of course, in business and professional services and financial activities. And then manufacturing has been facing a lot of headwinds over the past year or so as the dollar has been stronger, so you see a very small number there. But trade and transportation, a lot of jobs created in these sectors here. So that's looking pretty good on a national level. If you look at a couple of other things that gave economists headaches for a long time, one is income and wage growth. Income and wage growth has been pretty stagnant for a long time now, and incredibly stagnant, if not negative, for the past, since the recession. Over the past, I don't know, 5-6 months or so, there's been a significant increase, or at least something we might consider a reasonably good increase in income and wage growth. So you saw that in late 2015 and into last month, January 2016. This had been, as I said, a concern for a number of years. People were worried that middle class jobs, and this is still a concern, of course, but middle class jobs were on the sort of way out, and that there was going to be sort of this bifurcation between the really, really wealthy and the not so wealthy. But when you have wage growth, that starts to look a little bit less likely. The average work week and average hourly earnings were both up in January, about 2% annualized income growth. Over the past, say, since October, we've been seeing this kind of a trend, 2.5, 2.2, 2% annualized growth. Way better than it had been, and significantly higher than the inflation rate. The inflation rate is practically zero, right? So it has been for a long time. So real wage growth has actually gone up, which is a good thing. And then I know that this is a sore point in this state, but we do have to remember that low gas prices have a very, very positive effect on people's income, even us, right? So it has a kind of weird effect here. It's got a mixed effect here, but on average, your typical consumer saves $750 a year due to the kinds of gas prices we're seeing right now. So that's basically like a little tax break almost. Now, in a really strong economy where people were like, yeah, okay, good, jobs are growing and unemployment's going down and woohoo, that would translate into a lot of extra spending and some economic growth. That hasn't really been happening. Most people, with their savings from their low price of gasoline, are doing incredibly weird things like saving it. Oh no, what's up with that? No, that's good. We are really terribly bad savers as a general rule. So that's actually been kind of interesting. That's another kind of hangover from the recession, right? We're like, oh, maybe we should save some more money. So not translating into a lot of spending, but translating into some savings, which has got its own merits. If you look at, so this is a graphical representation of the average hourly earnings numbers here. This goes back to right before the recession. You can see they really flattened out here, and they weren't going up at a very high rate. These are in raw dollars. That's not a percentage. They weren't going up at a very high rate, just barely keeping pace with our very low rate of inflation, but they've started to sort of jet up a little bit here. So that's all good. All right, yay. End of good. all bad now. No, I swear, really, this is actually where it kind of gets sad. China, everybody, okay, so there's a big contingent of economists say, we're fine, everything is looking a lot better, we're moving along to the positive. There's a whole other contingent of economists over here like, oh, we're not so sure. And then there are those who are just like, we're doomed, right? And a lot of the reason why people say we're doomed is because China has been slowing down significantly. And we're like, you know, there are some people who go, they've got like a 5% or a 6% economic growth rate. What do you mean they're slowing down? Well, keep in mind that that 6% growth rate or even 7% growth rate doesn't necessarily keep up with their population growth or with the expectations of their population, since they have been rapidly growing over the past several years. So that can cause all sorts of internal social turmoil there. And then as they slow down, if they have less disposable income, they don't buy as much of our stuff, right? They don't buy as much of our raw materials. They don't buy as much of our exports. Like one of our major exports here in Wyoming is tourism, right? So they don't go on as many trips, they don't spend as much money. And that translates into some significant slowdown headwinds for the national economy as well, because a lot of job growth has been tied to the boom in China. Another interesting thing, which I think you guys were the first group I ever put this up to show, and I think it was last year, and I still have the same graph. I just have to keep ticking the number on the bottom line here up. The average length of a US expansionary period is 39 months. So the average good time rolling is 39 months. Now, granted, we went through a pretty huge recession, not just huge, a disgustingly giant long recession, right? So you're gonna expect that it's gonna take a long time to recover, and that it's gonna, you know, this growth rate being positive is not gonna be that strange. But once you start hitting that long, 79 months, that's interesting. Okay, I don't know what it means. I don't know if that means that we're about to have a recession, but it just sort of, it's interesting to keep in the back of your mind. That could be that you just go, wow, that's great. Good job, American economy. You have been growing for 79 months, almost 80. Let's keep that up. Or you could say, ugh, that's scary, okay? I'm not really sure what your reaction should be. I don't know what my reaction is. I just think that's an interesting number. If you look at other economists, though, I will say the Wall Street Journal has a monthly survey that they do of 60 very well-known and well-respected economists, and they ask them the same questions about GDP growth and recession and inflation and sort of basic economic indicators every month. And then they ask them 4 new questions every month. And one of their questions this month was, what do you think your GDP growth forecast for the next 12 months? Will it be more to the upside or the downside? That's economist speak for, will you reduce your GDP growth forecast, or will you increase it? And you can see that the vast majority say downside. In other words, they are expecting there to be a recession, okay? Or at least a significant slowdown. So not necessarily going into negative growth, but into much lower growth. So the recession probability that came out of that forecast this month is 17%, around 17%. It's usually in the 12 to 13% range. So that's kind of interesting. That's a little bit more than I would have expected. But these guys, the guys and ladies that they interview don't tend to be a bunch of kind of just fly-by-night folks. They're pretty smart. So I found that interesting. If you look at some of the other indicators out there, there are lots, as we've already said, lots of credible forecasts that China has slowed down. We have extremely low inflation. We've had extremely low inflation for a very long time. The Fed, just like a month ago, finally increased interest rates to something positive as opposed to 0. Basically, ask UniWyo about that, right? They finally increased it. You're still seeing mortgage rates and all of the sort of other interest rates that come off of that interest rate fairly low and moderately growing, if at all. So we still have extremely low inflation. This can cause low inflation sounds like, what's the big deal? That sounds like a good thing. But the problem is low inflation incites cautiousness as well. We've got a lot of cautiousness going on around the economy. But when you think that things are going to get cheaper over time, in other words, you think there's going to be deflation, you tend to wait until that happens to buy stuff, right? So you may say, oh, I'm going to go get that big, beautiful 80-inch LCD TV out at whatever, Walmart or Best Buy. But I think I'll wait until next month, and then next month, and then next month. And you just keep putting off your expenditures. And that can be a bad thing for an economy too. So this is kind of an interesting long-term thing. We haven't seen a significant period of this low of inflation for such a long period of time. It's another kind of weird, wacky thing out there. The stock markets, I don't know, it's kind of hard to believe, but they've been incredibly volatile. Like we have on CNBC in the morning, and I usually just turn up the radio so I don't I see red numbers and I'm like, oh, just turn it off. I don't want to see it. But the stock markets have been incredibly volatile, not just ours, but everybody's, right? Japan's, China's, obviously, because they're kind of the source of this right now. But Europe's, everybody's has been kind of crashing a little bit. The dollar strength is bad for people who are trying to sell stuff abroad. So if, anything that you're trying to export, which is what most of our manufacturing sector does, that's going to be a headwind for them. So the dollar strength is in some ways a good thing, but in some ways it's a major headwind for middle class job growth because manufacturing is still a source of good middle class jobs. If you look at, oh God, maybe just look at your phones now because we're going to talk about Wyoming. Yeah, it's okay. So look, we still have it's interesting. We have, the numbers haven't caught up quite yet to the reality. We still have a very good unemployment rate. It's about 4.3%. Highly variable, county by county. Last spring and into the summer, I went with the Wyoming Business Alliance on a thing called the Tour 23. We went to every county in the state. We went to Lincoln County twice because it's really, never mind, it's a big county, and the South and the North needed their own thing. So, and the interesting thing that we were starting to see already was what, we're starting to see in the budget discussions. There were people at the Gillette Applebee's who used to be making $120,000 with the coal company or on a gas platform, and now they're working at Applebee's. We were starting to see that already. There's a lot of variation across the counties in what that number looks like. Albany County has a very low unemployment rate, always has, okay? But if you go to a place like Sublette County, it's going to be a lot higher. But right now, we still have a very, very low unemployment rate, still lower than the national average and has been for quite some time. Here's where you start to see the numbers catching up though. Here's the unemployment rate. Again, that's this yellow thing. But this number right here, this is the number of jobs. That's employment in the state. And so here, that's kind of Jonah and the gas fields and oil and all of that kind of, right? Jonah's there, the gas fields and oil are right here. And you definitely see that run up here as the price of oil was going up and up and up and up. And a lot of people started saying, well, we may not be able to get very much for the gas, but the oil is next to the gas, so let's go get the gas and the oil, right? It's $100 a barrel. But then the Saudis happened and other things happened so that the economy is pretty much awash in both oil and gas, and their prices started to fall. Gas prices fell for a long time before this, but you are starting to therefore see right there, that's where that starts to manifest itself. So our unemployment rate being so low, it's a point of pride, and we should be proud of that. But you have to also remember that here's another thing to look at right here. There's our labor force. When the jobs that we were talking about on that last slide go away, people leave. right? So our unemployment rate can stay pretty low for a long period of time because people leave. So it looks like it's still pretty low, but it's not, all right? If you were to take into account the fact that people are just like, I'm going somewhere else, right? Now, in the past, over the past here, well, I'll just do it here, even right through there, as gas prices, natural gas prices were starting to fall and fall and fall, we still saw a number of people who stayed in Wyoming and went and worked for 2 weeks in the Bakken, or 2 weeks in Texas, or 2 weeks up in Alaska. Their family stayed here, their job was counted here. They didn't move because they could leave the kids and the wife and everybody here, you know, keep the unemployment rate good, but their job was somewhere else. Now the jobs that they were going to are also gone, right? So there's no, they just lost their jobs and now they're somewhere else. They're probably taking their families. So the labor force you can see here again, here's nice big run up to Jonah, here's the nice big oil run up, and then it has started to tumble. You've started to see it in what people say and do on the ground. You are seeing it on the ground. So the numbers haven't quite caught up. If you look at, you know, here's, good grief, should I just, no, let's skip that. That's too sad. That's sad, 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 falling, 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 right? And here's where everything was starting to look up, because even though this was happening, natural gas prices were falling, we still had oil prices to fall back on and oil to produce at this higher level. But now that incentive has gone away as well. And I mean, if you look at the price of oil right now, it's not that, so this is inflation adjusted. This goes back to 2000, and this is just to add some perspective, right? This, you know, here's the run up during the housing bubble. The price of oil obviously went up then. And then it also went up here during the fracking boom as frackers shifted from gas over to oil. So you saw a lot of really high prices through here, but then there's so much gas, there's so much oil, and the Saudis said, we're tired of it. We want you people out, so we're driving you out with the price. So this is an interesting historical perspective, because you can see oil prices are about down, inflation adjusted, to where they were when the terrorist attacks happened in 2001. Right? Which of course incentivized a lot of increase in the price of oil. But this is an interesting historical perspective. This is, you know, in the late 90s and into the early 2000s, oil prices were about where they are now. So that's just another interesting fact. Oh, more sadness. Sorry, this is production of natural gas. You can see it's been falling, and oil production rose but has been falling again. These are the most up-to-date as of last Friday, but Economic Analysis, Jim Robinson, who does all of this stuff, he just put out a new one today. So sorry, I didn't have time to put it in, but it's going to look about the same. There's just going to be filled into December. But you can see natural gas falling. Here's the employment rate going back here to 2006, 2005. The yellow one is Casper, blue is Cheyenne, Wyoming is the kind of solid red right there, and that's the US employment numbers right there. So you can see that there was we were doing really, really well here in Wyoming for a lot of the last 15 years. And then if you look at employment in our biggest sectors, which are leisure and hospitality is what L and H is, sorry. Construction, mining, you can see that the mining and construction sectors have both had, well, construction's kind of bounced back a little bit, but mining has dropped significantly. And here is leisure and hospitality. That's like our bright spots. We have seen huge, oh my gosh, I sound like Donald Trump or Bernie Sanders, I'm not sure which one, huge increases in our tourist visits to the national parks, to the state parks, to all the parks, right? People are like, let's go see Wyoming. This is good. That brings money, all right? That's good. So you can see that that's been kind of doing fairly well there. But mining, you've started to see the jobless claims are starting to increase at a pretty rapid rate. They've almost doubled compared to this time last year. And employment is down 30%. So you are starting to see the numbers catch up in that sector especially. If you look at what that does to our tax collections, which here in Albany County, that's a special interest because, you know, we get the city and the county both get some monies from sales and use tax collections. But if you look at after the first 6 months of FY16, total collections were 17% below where they were last year. So that's what this blue line right here shows. And here's the 5-year average. You can see it's fairly volatile because we're talking about most of this comes from extractive industries. So it's kind of volatile, but you can see it's already lagging behind significantly. And if you look at severance tax collections, also fairly substantial interest to us here in Albany County because of a lot of things, but not least of which is the university. After 5 months, FY16 year-to-date collections were about almost 36% behind where they were last year. So this is why the guys over on the other side of the hill and women are going, oh, crikey, right? We got to do something, all right? So whether you agree with how they're attacking it or not, this is why they're doing that, right? This is not fun to look at. If you look at, all right, I said that was the last happy thing. Here's a happy thing right here. National Park recreation visits to Wyoming up 13% this year. That's pretty good. So there's Bighorn Canyon National Recreation Area, Devil's Tower National Monument, Fort Laramie, Fossil Butte, Grand Teton, the Memorial Parkway outside of Grand Teton, and Yellowstone. Yellowstone and Grand Teton together, pretty huge there. So you can see there's been a huge increase, right? 13%, so over 800,000 increase in park visits to just the national stuff. And we've seen a lot of the state parks. There was a report came out a couple days ago. The state parks have also had a big increase, so that's good. The forecast from the Economic Analysis Division, here you can see, if you just kind of zoom in on 2016, which is this column right here, that's where they expect the vast majority of the impact to hit, which is now, right? And then it kind of moderates after that. But the largest amount of job loss is between last year and this year. The largest drop in personal income is between last year and this year. Sales and use tax collections way down. They're very, very conservative about their oil price predictions, which is probably a good thing. We don't want them overestimating how much money we're going to get, because we've got to be careful about how much we spend. Natural gas price, also fairly moderate increase, and production falling a little bit. Coal price, they're estimating that it will remain about constant, but that production will fall because we are starting to see a lot of the coal companies with their share prices falling significantly. Many of them are declaring bankruptcy as well. So, and from time immemorial, coal has been a bedrock of our economic growth, right? First with the railroads, and then with its low sulfur properties. So the last time this kind of a drop off happened was in the uncertain times in between the UP switching off of coal and people starting to use our coal for electricity generation. But now natural gas is cheaper to use for electricity generation. So that's a big headwind for them. So that's why we're seeing that. Okay. You guys, this is the saddest I've ever seen you. I'm so sorry. I feel so bad. You're like, pin drop. You're staring at me with these sad puppy dog eyes. I'm sorry. But so the economic, oh God, should I really talk about this? Yes. The economic anxiety, because now I want to zoom in. It's like this sad and scary and uncertainty. There's a lot of uncertainty. There's a lot of headwinds coming at us, right? But I think it's important for us to think about what we have control over in our own county, our own city, our own lives. If you look at, it's not just Wyomingites that are anxious. This is a national survey. This is done now on an ongoing basis with the Marketplace Group, which is an NPR business show, and Edison Research. And they have been doing this basically this temperature taking of the American public over the past several months, and they're going to continue looking at these numbers. 63%, not just us here in Wyoming, but everywhere, are anxious about their financial situation. We still see that in what they call the JOLTS report as well, the job turnover survey. People are still nervous about quitting their jobs and looking for new jobs because they're just not sure they're going to find one. 27% say they're not financially secure. 28% say their personal financial situation causes them to lose sleep. 10% fear being unable to make a car payment or a mortgage payment. 25% fear being unable to pay rent. 33% fear not being able to make a student loan payment. More than 30% fear they haven't saved enough for retirement. How many of you feel like you've saved enough for retirement? Okay, all right. So that's, there we go. It's flipped in this room. No, that's good. That's a very important thing to do. More than 25% fear facing an unexpected medical bill, even though we have had insurance market reforms. 38% fear losing their job in the next 12 months. That's nationally. So imagine how kind of skittish we're feeling here, right? I mean, but this is what I want you to focus on. Not Ari himself, but the keys to your financial stability. Even when times get tough, there are 3 things you need to remember, and UniWyo can help you with this, but you can help you with this. Your frame of mind can help you with this. Live below your means. I love this, right? The goal isn't to look rich, it's to be rich, right? Live below your means, and I think a lot of people in college towns are really good at that, right? I mean, I talked to one of my music professor colleagues a few weeks back. He's on the faculty senate. He eats ramen at lunch every day because he feels guilty if he eats anything else, because he's still like in that mindset of grad school. And you know what that did? That made me like, yeah, you know, I used to like ramen a lot. So I totally get this, right? But actually, you know what? He should continue in that mindset. He should continue eating ramen at lunch as long as it doesn't disgust him, because that's going to help him be more stable in the long run financially, right? So the goal isn't to look rich, it's to be rich, right? Keep things simple, a diversified portfolio. Within your own personal risk tolerance, I am an incredibly risk-averse person. And most people would look at my retirement portfolio and go, are you like 80 or something? Because you act like you are in your investments. And I'm like, no, it's just, my parents were born in the Great Depression, so I am really, really risk-averse, hugely risk-averse. But different people have different tolerances for risk. So this is not a ding on you to say if you're a very risk-averse person and you're young, that's bad. But you do need to keep in mind how long it's going to be before you retire. You should set future goals. You should keep your eye on those goals personally and not move them, all right? Not move them. Unless you're really close to retiring, like I said, drop the quarterly statement and back away, okay? Absolutely. Stay the course. Have grit and determination to stand by your financial decisions in challenging times. If you were to have called your TIAA-CREF or whoever other broker it was last week and said, or a couple weeks ago, oh my gosh, I got to get out of this market, it's going down. That's the opposite of buy low, sell high, right? That's selling low. No, 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 you want to buy right now, right? Buy, 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 it's all cheap. So don't make rash emotional decisions when it comes to finances especially. You know this when it comes to like buying a car and all that stuff. It's the same thing with your retirement portfolio or any of your other investments. Just stay the course. Keep the eye right. We'll go back from Snape for a second. Someone's sitting in the shade today because someone planted a tree a long time ago. Warren Buffett, that's actually a paraphrase of a Chinese parable, but it looks good when it comes from Warren Buffett. So I think that what he's saying here is that you need to be diversified. You need to keep it simple. Don't like try to play the market. Don't try to beat the market. Don't try to take the stock tip from your uncle. Just stay the course. Keep your goals the most in mind. And that's with everything, not just your investments, but that's a pretty good thing to do in life. And then, yeah, just don't open those financial statements. Do stay the course. If you are about to retire, it's not necessarily a bad thing to take a look at how much money you have. I understand that. But even then, you're not going to die the day you retire, right? You got to continue the money still has to grow because you are going to live on and enjoy things and go on trips and go see your grandkids and whatever else it is you're going to do, and you're going to need the money for that stuff too. So focus. These are scary, uncertain, weird, crazy times, but these things you can do for yourself. And I think it's important for us in the context of a big, nasty, scary presentation like that, especially to remember what you have control over, and it's those things right there. So that's my dog Hutch. He's very sorry that his mama made you very sad. So, well, I will just wrap it up and say thank you all. I really am so appreciative that you were able to come today, and I'm sorry I didn't have the happy news today. But, you know, back away from just remember Snape, walking away. Don't look at your quarterly statement. Stay the course. All right.